So our revenues are up 14% year over year. And of course, most of that growth came from the investment bank. The investment bank is up 32% year on year. Also asset management, 23% year on year. Very good performance. But it's important not to let the strong performance in those businesses overshadow what we think is also excellent performance in the private bank and the corporate bank. We've talked about how those businesses are still fighting through the headwinds of negative interest rates, but that we're seeing underlying growth in them, more than offset, or offset at least, the interest rate headwinds. And so we're very pleased with the performance there. And on a pre-tax basis, both of those businesses improved their year-on-year pre-tax profit by over 90%.
Let's talk a bit about the investment bank. So how did you manage to increase revenues and also be almost ahead of your competitors when it comes to the FIG space?
You're right that we think we're at least in line, if not ahead of our competitors, as we've seen so far in the FIG business. It's a number of different aspects. First of all, I think the excellent execution that Ram Nayak and his team have provided in simply building the franchise, re-engaging with clients, and managing to the objectives that we've set. In our case, the credit business, year on year, of course, was very strong. And so you had some mark-to-market losses in the environment that we had last year, and a pretty strong environment for credit this year. What I'd call the macro products of FX rates and emerging markets, we have seen some more normalization through the course of the first quarter. And so for us, it was, I think, a favorable mix and a very favorable year-on-year comparison in the credit business.
Is that momentum which you have been witnessing in the first quarter in the investment bank, has that carried over to the second quarter as well?
Well, the normalization that I see certainly in the macro areas has continued into the second quarter. But the overall environment, I would say, is still reasonably encouraging. Pipelines are strong. Corporate activity is still encouraging. We've taken the opportunity to raise our guidance for this year for revenues in the investment bank to being in line with 2020. And that reflects really the very strong first quarter rolling through to the full year, but an environment that we still think will be constructive.
Have you been benefiting from the boom in SPACs?
We have. We've participated in the increase in special purpose acquisition company activity in 2020 and particularly in the first quarter. For us, it's a business that we've been in for a very long time, and we've been a leader in SPACs for many years, and are pleased to have participated in this rise in activity. We think it's a product that will continue. But of course, it's enjoyed a boom in unusually favorable conditions.
Let's talk a bit about risk management, because many other banks, especially the Swiss banks, but also some in Asia, did have major problems in the first quarter because of Greensill and the hedge fund in New York, which went bust. So how did you avoid that?
Well, I'd say, first of all, risk management is and also strong frontline, first line sort of management, not only of our client selection, but of the risks inherent in the activity that we do. We were not involved in one of the two cases that you mentioned. In the case of the prime finance client, we were, but our risk management served us well, and we had no loss, and were able, in fact, to hand excess collateral back to the client, and managed, I think, quite successfully through that situation. So we're pleased with how our risk management functioned. Of course, we'll always learn lessons and look for where there may have been weaknesses, but the outcome to us speaks to our strong risk management capabilities.
Talking about targets, you've been saying that you've increased the outlook for the investment bank, but how is it for the overall bank? Because you would clearly overachieve the targets if we were to extrapolate the first quarter over the whole year.
Sure, yes, which you can't do. I mean, the first quarter conditions were unusually favorable, but it does for us give us real confidence in the revenue trajectory that we described to investors last December. We think at this point all of the businesses, all four core businesses, are ahead of the revenue trajectory that we were planning for. It gives us even greater confidence in the 2022 revenue number that we showed investors, that is a key part of achieving our return on tangible equity target of 8% next year. And so it underscores, if you like, the confidence in that path, but also that we made the right decisions and we've been executing well.